You know what happens when 38 people show up at a bank demanding the same dollar? The bank fails immediately, not because it's insolvent, but because it's illiquid. The fundamental premise of fractional reserve systems is that only a small percentage of claimants will ever demand physical settlement simultaneously. But when confidence breaks, when industrial users start demanding actual metal instead of accepting cash settlement, when investment funds decide they want bars they can audit rather than numbers on a screen, the system implodes because the math doesn't work. And we're watching that confidence break in real time as silver hits $78 and COMEX registered inventory keeps draining at accelerating velocity. Let me show you the bank losses that are piling up right now and why the $50 billion wave mentioned in the title is actually conservative. According to the CFTC's most recent Commitment of Traders report, commercial short positions in precious metals, that's the combined gold and silver shorts held by banks and institutional traders, total approximately 800,000 contracts across both metals. The average short position basis for silver is estimated around $32 per ounce, based on when most of these positions were established over the past 18 months, at $78. That's a $46 loss per ounce. Multiply $46 across the silver short exposure, which represents roughly 2 billion ounces, and you're looking at $92 billion in mark-to-market losses just on silver. But it gets worse because gold shorts are also underwater. The average commercial short basis in gold is estimated around $3,800, with gold now at $4,530. That's a $730 loss per ounce. The notional short exposure in gold represents approximately 40 million ounces. Multiply 730 times 40 million and you get 29 billion in gold losses. Add that to the 92 billion in silver losses and you're looking at $121 billion in combined precious metals derivative losses sitting on institutional balance sheets right now. I said 50 billion in the title because I'm being extremely conservative, accounting for partial hedging and the fact that not all positions are equally underwater, but the real number is likely double or triple what I quoted. You know what it means when central banks that manage trillions in reserves all start buying the same assets simultaneously at record prices without caring about getting good entry points? It means they know something, they've seen the derivatives exposure reports, they've watched the bank stress indicators that aren't public, they've run the models on what happens when the Federal Reserve has to choose between fighting inflation and preventing government bankruptcy. And they've decided that holding dollars or euros or yen is more dangerous than paying $4,500 per ounce for gold. Think about that calculation for a moment. These are sophisticated institutions with hundreds of economists and analysts. They're not buying gold at all-time highs because they think it's cheap. They're buying because they think their current reserves in fiat currencies are about to lose catastrophic amounts of purchasing power. Now let's talk about silver at $78 because this move is even more significant than gold's rally when you understand the supply dynamics and industrial demand factors. Silver has been running structural deficits for 5 consecutive years, meaning global demand exceeds mine production and recycling combined every single year since 2021. The Silver Institute's latest data shows that 2025 will see a deficit of approximately 230 million ounces. That's metal being permanently consumed faster than it can be replaced, and unlike gold, which is mostly monetary and jewelry demand that can flow back into the market when prices rise, 70% of silver demand is industrial applications where the metal gets embedded into products and effectively disappears from available supply for decades. Solar panel production alone consumed 220 million ounces in 2025. Every single panel requires silver paste for the electrical connections that make photovoltaic cells function. You cannot substitute copper or aluminum because silver's conductivity properties are essential for efficiency, and the solar industry isn't slowing down. Global solar installations are projected to increase 15 to 20% in 2026 as countries race to meet climate commitments and reduce dependence on fossil fuels. That means silver consumption from solar will hit 250 to 260 million ounces next year. Electric vehicle production added another 95 million ounces of demand in 2025. Every EV requires approximately 1 ounce of silver for electrical contacts, charging systems, and battery management. with EV sales projected to grow another 25% in 2026. That's industrial demand that cannot be delayed or substituted regardless of price. Here's the crisis that nobody's explaining clearly enough for retail investors to understand. COMEX registered silver inventory, the actual physical metal available for delivery against futures contracts, has collapsed to 68 million ounces as of December 27, 2025. That's down from 140 million ounces in January 2025, a 51% decline in 12 months. But here's the number that reveals the mathematical impossibility of the current situation. Total COMEX silver open interest stands at 512,000 contracts. Each contract represents 5,000 ounces. That's 2.56 billion ounces of paper silver obligations. Divide 2.56 billion by 68 million, and you get a ratio of 37.6 to 1. Meaning there are nearly 38 paper claims for every 1 ounce of physical silver actually sitting in COMEX vaults available for delivery. Second catalyst, arriving January 3rd, 2026, the first trading day of the new year, we get December employment data from the Bureau of Labor Statistics. If the report shows continued labor market weakness, which recent ADP and jobless claims data suggest is likely, the Federal Reserve's credibility on their higher for longer narrative collapses completely. Markets will price in rate cuts starting in Q1 2026, regardless of what Fed officials say publicly. Lower interest rates eliminate the opportunity cost of holding non-yielding assets like gold and silver. When Treasury bonds pay 5%, there's a trade-off to holding metals that generate no income. When Treasury bonds pay 3%, that trade-off narrows dramatically. Rate cut expectations will accelerate investment demand on top of the industrial demand that's already overwhelming available supply. Third catalyst, building through January. The solar industry hits peak procurement season for 2026 installation schedules. Manufacturers need to lock in silver supply 3 to 6 months before panels roll off production lines, and they're competing for metal in a market where COMEX vaults hold 68 million ounces while their collective needs for the year exceed 250 million ounces. Think about what happens when solar companies realize they cannot source enough silver through normal channels at any price. They'll start offering premiums over spot. They'll bypass exchanges entirely and deal directly with miners and recyclers. They'll create a parallel physical market where actual metal trades at prices completely disconnected from paper contracts. We're already seeing early signs of this in Shanghai, where physical silver has been trading at $8 to $12 premiums over COMEX futures for the past 2 weeks. Fourth catalyst, arriving January 20, 2026. Presidential inauguration day in the United States. Regardless of political views about who wins, the incoming administration will face immediate economic policy decisions about tariffs, fiscal spending, and Federal Reserve appointments. Any signals of increased deficit spending, trade wars, or political pressure on Fed independence will accelerate the flight from dollars into hard assets. Gold and silver rallies aren't happening in isolation. They're happening because institutional investors globally are losing confidence in fiat currency management and central bank credibility. When the world's reserve currency issuer demonstrates fiscal irresponsibility or monetary policy mistakes, there's nowhere to hide except hard assets that can't be printed. Fifth catalyst that becomes critical in February and March 2026. Chinese New Year falls on January 29, creating massive physical buying across Asia. But this year the dynamic is different because China implemented export licensing requirements for silver in January 2025, effectively giving their government control over 60 to 70% of global refined silver supply. When Chinese industrial users and investors realize that silver might not be available for export at any price if geopolitical tensions escalate or domestic needs take priority, the panic buying inside China will create physical shortages globally that make current premiums look trivial. During previous supply disruptions, we've seen physical silver coins trading at 60% premiums over spot. Imagine what premiums look like when the world's dominant refining and processing nation stops exporting metal entirely. On December 28, 2025, something happened that hasn't occurred in the entire history of modern financial markets. Gold and silver simultaneously broke their all-time highs on the same day. Gold touched $4,530 per ounce in Asian trading Before pulling back to 4,515, silver exploded to $78.11, the highest price ever recorded since precious metals started trading electronically. And here's what makes this different from every other rally you've witnessed over the past 2 decades. This isn't speculation driving prices. This isn't retail investors chasing momentum. This isn't even hedge funds making directional bets. This is central banks panic buying at a pace we haven't seen since the 2008 financial crisis. This is institutional money flooding into physical metals because they've seen something in the derivative markets and banking system stress indicators that tells them the next 60 days will determine whether our financial system survives in its current form or undergoes a catastrophic restructuring that makes 2008 look like a preview. Let me show you exactly what's happening right now that financial media is desperately trying to downplay or ignore completely. In the past 72 hours alone, global central banks purchased an estimated $17 billion worth of gold. That's not the monthly total, that's 3 days of buying. The World Gold Council reported that central bank gold purchases in December 2025 are running at triple the pace of December 2024, which was already a record year. China's central bank, the People's Bank of China, added 42 tons of gold to reserves in the past 2 weeks, according to their official disclosures. But industry analysts estimate the real number is closer to 70 tons when you account for purchases through unofficial channels and state-owned entities that don't show up in PBOC reports. Russia bought 28 tons, India bought 15 tons, Poland, Singapore, Turkey, even smaller nations like Czech Republic and Serbia are accumulating gold at rates that would have been unthinkable just months ago. Now here's where this situation turns from concerning to genuinely systemic. These aren't isolated losses at one or two rogue hedge funds. This is concentrated exposure across the 5 largest US banks that dominate precious metals trading: JP Morgan, HSBC, Bank of America, Citigroup, and one other institution whose identity isn't publicly disclosed in aggregated CFTC data. When you have 120 billion in losses concentrated among 5 systemically important financial institutions, you create counterparty risk that spreads like contagion through the entire derivatives market, because these banks don't just trade precious metals, they're counterparties in interest rate swaps, currency derivatives, equity options, credit default swaps, every corner of the $50 trillion global derivatives market. If one of these institutions faces margin calls and liquidity stress forcing them to liquidate positions across multiple asset classes simultaneously to raise capital, that creates selling pressure in unrelated markets. We saw this exact pattern in September 2008 when Lehman Brothers mortgage losses cascaded into a broader crisis as counterparties refused to trade with them and margin calls forced asset sales that drove prices lower, creating more margin calls in a death spiral. The concentrated precious metals losses we're seeing now could be the spark that exposes broader weaknesses in bank balance sheets and derivative positions that regulators keep insisting are well managed and pose no systemic risk. They're lying, or they're incompetent, or they genuinely don't understand the interconnectedness of modern financial markets. Regardless, the outcome is the same. We're watching dominoes line up. Let me walk you through the timeline of catalysts that converge over the next 60 days, because once you see how these events stack on top of each other, the inevitability of what comes next becomes crystal clear. First catalyst hitting in 72 hours, December 31st, 2025 marks year-end for institutional position reporting and balance sheet snapshots. Those 120 billion in precious metals losses become official public record in quarterly filings that start dropping in mid-January. Right now, these losses exist in internal risk systems and trading desk calculations. In 3 days, they become something that boards of directors have to explain, that credit rating agencies have to evaluate, that shareholders and counterparties have to react to. The shift from private stress to public accountability changes everything about how urgently these positions need to be managed. But the real acceleration comes from the gold to silver ratio normalization that's mathematically inevitable at this point. The ratio currently sits at 58:1, meaning it takes 58 ounces of silver to buy 1 ounce of gold. Historically, this ratio has averaged between 45:1 and 60:1 over the past century. But during previous precious metals bull markets, we've seen extreme compression. In 2011, when silver hit $48, the ratio compressed to 32:1. During the 1980 Hunt brothers, Squeeze the ratio hit 16 to 1. Let's be conservative and assume normalization to just 40 to 1. If gold continues rising to $5,000 as central bank buying accelerates and Fed cuts rates, 40 to 1 puts silver at $125. If gold reaches 6,000, which becomes likely if dollar confidence collapses further, 40 to 1 means $150 silver. The timeline for when this breaks is now measured in weeks. January 1st brings export licensing enforcement from China. January 3rd delivers employment data that could force Fed pivot. January 20th inauguration creates policy uncertainty. January 29th Chinese New Year buying hits. February and March solar procurement season adds industrial demand. And throughout this entire 60-day window, the COMEX vaults keep draining while open interest stays elevated. There is no source of new supply large enough to refill vaults, mine production is fixed in the short term, recycling can't scale fast enough, and the institutions that used to provide liquidity by shorting rallies have either flipped long like JP Morgan or are trapped with losses too large to exit without causing price explosions. For investors, the message is brutally simple. The window to acquire physical gold and silver anywhere near current prices is closing in real time. Every single day that passes, more central banks buy, more industrial users lock up supply, more vault inventory gets claimed for delivery, more institutions realize the paper game just ended. I'm not telling you to panic buy or make emotional decisions. I'm telling you to look at the same data that made JP Morgan close 200 million ounces of shorts and flip to a billion-ounce long position, to understand that when gold and silver simultaneously break all-time highs on the same day while COMEX vaults drain and central banks panic buy, you're not watching a normal bull market rally, you're watching a monetary system transition in real time. The 120 billion in bank losses I calculated, that's with gold at 4,530 and silver at 78. At $6,000 gold and $150 silver, those losses exceed 300 billion. At that point, you're not talking about isolated institutional stress, you're talking about potential bank failures, credit rating downgrades, counterparty contagion spreading through derivatives markets, and Federal Reserve emergency interventions to prevent systemic collapse. We saw the preview in 2008 when concentrated mortgage derivative losses cascaded into a global financial crisis. Precious metals might not be big enough to cause the next crisis alone, but they could absolutely be the catalyst that exposes broader weaknesses in bank balance sheets and derivative positions that regulators insist are safely managed when they're absolutely not. The simultaneous gold and silver breakouts, the central bank panic buying, the COMEX vault drain, the 120 billion in institutional losses, the convergence of catalysts over the next 60 days, none of this is normal, none of this is sustainable, and none of this ends with gradual repricing and orderly markets. This ends with either forced liquidation at prices that destroy the remaining shorts, or exchange rule changes that prove the entire paper precious metals market was designed to suppress prices while insiders accumulated physical metal. Either way, the era of managed prices through derivatives is over. What comes next will be determined by supply and demand physics, not financial engineering, and physics says you cannot print gold, cannot manufacture silver beyond what geology allows, cannot satisfy 38 paper claims with one physical ounce. The question isn't whether we hit $100 silver and $6,000 gold. The mathematics make those levels inevitable. The question is whether you positioned before the break or whether you're learning about it after the wealth transfer already happened. Gold just hit 4,530, silver just hit 78, both at all-time highs simultaneously. Central banks are panic buying at crisis levels. Banks are sitting on 120 billion plus in losses. The 50 billion wave I mentioned in the title is already here and accelerating. And we're 72 hours from year-end reporting that makes all of this officially public. The game is over. The only question left is which side of the trade you're on when the system breaks completely.